Deep Dive with David Stendhal, where we trade without ego, no emotion, no greed, and no opinion. Before we begin tonight's video blog, please read over our trading disclaimer and remember to trade smart and accept the reality that trading futures is risky. This presentation does not provide buy-sell recommendations, and our information is strictly provided for educational purposes only. As always, trade at your own risk and analysis. Hey, it's David Stendhal with tonight's Deep Dive. It is February 26, 2018, and tonight's market's going to be corn, the ETF being CORN. You can see that the short, intermediate, and long-term trends are all pointing to the upside. We've got a technical rating, which is positive, and we've got the seasonal tendencies that are positive. There's really nothing showing up in any of the overbought, oversold indicators, and to that point, there's really nothing showing up in a lot of the markets, but specifically in corn, as far as any of the pro alerts that look for profit taking, looking for reversals in the markets and things of that nature. So really just not a lot going on for the most part in a lot of the different markets. But the one thing that is showing up for corn is that it's at the top of the seasonal accuracy level. So we have all four time frames. That's what the 1, 2, 3, 4 represent, and those represent the 5, the 10, the 15, and 20-year time horizons as far as the seasonal accuracy to the market. The darker blue line is a culmination of the correlation for those four time frames against the individual market. So that's why it's at the top of the list here. And if we take a look at corn, oops, that's not it. If we take a look at corn, the market, a couple things are going to sort of stand out here. You can see a little bit of a trend to the upside. We have broken through a little bit of support and resistance. That's what this level is here, both at this level, which is at 375, another level back, which was at 378 and 3/8, and then this level is the next one that's coming up here. I'll just call it 383. I think that you don't have to really look at these numbers. I'll look at a weekly one as well. But if you just simply keep tabs on the 200-day moving average, that's where I think we'll find some resistance to the market. If we take a look at, as an example, the weekly charts, this is the next major resistance to the market. Right now it's below this level, and this is the key level, 386 and 7/8. We'll just call it 387. That's where I think that we're going to find some major resistance to the market. Now, with the seasonal tendencies, it wouldn't be surprised if we saw a little backfill, a little surge, a little backfill, and a little bit of a surge. But do keep in mind either A, the 387 level, or if I flip back to the daily charts, which the 200-day right now is at 383 and 6/8. That's where I think that you're going to find a little bit of a resistance to the market. And again, if we take a look at the seasonal tendencies here, what you'll see is this. Let me just pull this back here and take a look at the seasonal charts here. So here's corn. We got the 5, the 10, the 15, and the 20 years as far as those that can pop up. If you have a gray area, what you'll see is that the market is accurately following its seasonal market, in this case the 5-year chart. The black line represents this year's information. The blue, in this case, represents the 5-year normal tendencies to the market. So it's been tracking it pretty well. There's a little bit of a dip that's coming according to the seasonal charts, but nonetheless still a trend to the upside through early April, and then the market kind of goes sideways on the 5 years. 10 years a little bit different, choppy, but still has the trending nature up until, call it, early June or so. If we take a look at the 15-year, it's a little more pronounced where the market has a tendency to sell off into early April and then has a rally. And so we'll see as whether or not the tendencies to the market, whether it's the 5, 10, 15, or 20-year charts, if they really hold true here. But for right now, I wouldn't be surprised if we see a little bit of a dip and then another surge here. And that's where, once we get into this next surge, that we might possibly see some opportunity excuse me, for the market to really start to head higher here and start approaching that 200-day moving average. The other thing I'll point out, and this is one that I typically don't show, but It's the pause indicator, these little white dots. We just had a white dot not too recently ago, not too far back here. And whenever you get this type of a dot, it means that the market's taking a pause. You know, it has had a surge. It has gotten into either overbought or oversold territory. In this case, light overbought territory. And then what you do is you watch that dot over the coming days or so. So the market did in fact sell off a little bit based upon the pause, and now we're back to approaching that. We had a pretty nice move in corn today. So this typically means that the market can have a bit of a rally, and so we'll see as to whether or not the market is able to continue on from that side. So that dot, that high of that bar, is at 378 and a quarter, and so just keep that in mind as far as trying to get a close above that. If we're able to get that and then start to approach that 200-day moving average on daily bars, obviously those would be the targets. The market's a little winded here where it's had a nice surge, so a little backfill and then another surge is what we'd like to see take place to give a little more longevity to the trade itself. Now, as far as we're concerned, when it comes to where we are with our trading, our systems are actually long the market. We've got two positions out there. We have one that was established today on the 26th, and it's got a small little loss going on. And then we have another system, which is, in this particular case, been long on a daily bar basis since mid-January or so. So on a per contract basis, we're doing okay, nothing spectacular. But nonetheless, we are long the market, and we'll have to see as to whether or not we're able to maintain this. Should we get that little dip backfill and then another surge to corn? But do understand that between now and either April, or if you go even further out to June, as I was showing with those seasonal charts, just expect the trendiness to the market to subside a little bit, and it's going to be much more choppy and therefore more of a tradable environment. The last thing that I'll show here tonight is just a presentation that I'm working on that I'll be giving here in March in a couple of, maybe 2 weeks or so. And what I'm going to be talking about is just big picture, is the 4 stages that I like to look at when I look at a trading process. Market expectations, where you have to understand the market, understand what's good, what's bad as far as returns for that particular market, really get a feel for whether or not it's a market you want to trade. And then we get into the trading leverage associated with the market and how many contracts to trade. And to a degree, we use the seasonal tendencies that I just covered in leverage because I use it as a position sizing. Then a trading plan, some of the tools that we use as far as those alerts to be able to develop a trading plan for the market. And then systematic evaluation deals with turning those into systems and how to evaluate that system so that the system related to, let's say, for example, corn, what kind of a personality does that corn system and that corn portfolio have, and is it correct for you to be trading, and is it good for your capital base? So I just share that with you so you understand that we are working on some presentations to help to understand some of the specifics related to the different markets and how to utilize some of the tools that we have. So with that, I want to thank you, and we'll take a look at another market tomorrow. Thanks very much. Bye-bye.